All right, pause your scroll for a second and listen to this because something big just happened and most people are already misreading it. If you care about markets, risk, or protecting your capital, you want to hear this now. Silver just collapsed more than 21% in roughly 24 hours. We're talking about a drop from around $120 to under $97 an ounce, wiping out an estimated $1.4 trillion in paper market value almost overnight. And here's the kicker. While that was happening, physical silver prices in China barely blinked. Both futures volume data and Shanghai premiums confirmed it at the same time. That disconnect matters. Stay with me, because I'm going to show you why this wasn't a demand collapse, why it's flashing stress across the financial system, and how you can spot this pattern before the crowd next time. Before I explain what caused this, let me teach you something most people never learn about commodities, especially silver. You don't just trade silver, you trade leverage on silver. Futures markets are basically a high-speed highway where massive positions are built with very little actual cash. When prices move calmly, it feels smooth, but when price goes parabolic, leverage piles on fast. Think of it like stacking chairs on a wobbly table. It looks fine until one leg shifts. Most people watching price charts don't see the leverage underneath. You should. Because when leverage gets extreme, price stops being about supply and demand and starts being about margin calls and forced selling. And once that starts, fundamentals take a back seat, at least temporarily. So what does that tell us? It tells us that when you see a violent move like this one, your first question shouldn't be what happened to demand. Your first question should be what happened to positioning. If this is making sense so far, drop a comment below and let me know you're following along. It helps me know what's landing. Now here's what's actually happening. Silver had gone vertical, not gradually higher, but parabolic. As price ripped higher, traders didn't just buy silver, they borrowed exposure to silver. Futures positions ballooned. Margin requirements stayed relatively low. Liquidity thinned as everyone leaned the same way. That's the setup. Then price stalls for just a moment. That's all it takes. Margins get hit. Exchanges raise requirements. Some traders can't post collateral fast enough, so positions get liquidated automatically. That selling pushes price lower, which triggers more margin calls, which forces more selling. You see the cascade. It feeds on itself. Here's what's wild about this move, though. While COMEX paper prices were collapsing, Shanghai physical premiums stayed elevated, well above 20%. That tells you physical buyers weren't dumping. They were still paying up. Paper was deleveraging. Physical was tight. Now let me show you what most people are missing. When paper and physical diverge like this, it's not chaos, it's information. It's telling you that the selling pressure wasn't coming from people who actually use or want the metal. It was coming from people who owned contracts, not metal. People who needed to meet margin requirements, not people who lost faith in silver's value. That's a completely different animal. Let me break this down even further. When silver's trading on COMEX, you've got massive leverage ratios. You can control $100,000 worth of silver with maybe $5,000 in margin. That's 20-to-1 leverage. When price is climbing steadily, that's your best friend. Every dollar silver goes up, you're making $20 on your position. But when price reverses, that same leverage becomes your worst enemy. You're losing $20 for every dollar silver drops. And exchanges know this. They know when volatility spikes, risk spikes. So they raise margin requirements. Suddenly that $5,000 isn't enough anymore. They want $8,000, $10,000, and they want it now. If you can't post it, they close your position. They don't ask. They don't wait. They just liquidate. But here's the part that should make you pay attention. This wasn't isolated to just one exchange or one group of traders. Reports started coming in from multiple brokers about margin calls hitting at the same time. Volume data showed massive spikes right as price was breaking key support levels. And all of this was happening while Shanghai premiums, the real-world price premium that physical buyers in China are willing to pay over spot, stayed high, really high, over 20% above London spot prices. If this was real demand destruction, Shanghai would have dumped too, but it didn't. Physical buyers were still lining up. They were still willing to pay premiums. The disconnect between paper and physical has rarely been this stark. That's your signal. That's what tells you this was mechanical, not fundamental. Now, before we go further, let's put this in context because if you've watched silver long enough, you've seen this movie before. Go back to 2008. Silver crashed violently during the liquidity crisis, not because demand vanished, but because leverage did. Credit markets froze. Margin calls rippled through everything. Silver got crushed along with almost every other asset. What happened next? It went on one of the strongest runs in its history, climbing from under $9 to nearly $50 over the next 3 years. Look at 2011, a massive parabolic rally that topped out around $48, followed by a brutal margin-driven collapse back into the 20s, followed by years of consolidation. March 2020 did the same thing. Silver crashed from $18 to $12 in a matter of days as liquidity dried up everywhere. Then it doubled over the next 4 months. Every single time this has happened, it felt terrifying in real time. And every time it cleared the deck for the next phase. The larger story is this. Silver is the market's pressure valve. When financial stress spikes, silver shows you first. It's volatile. It's leveraged. It moves fast. And when the system needs to shake out weak hands, silver is where it happens most violently. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be a real breakdown? Sure. Could demand actually be collapsing and we're just not seeing it yet? Yes. Could this be the start of a much larger unwind where silver goes back to $70, $60, $50? Maybe. Could this be manipulation by central banks or big institutions trying to suppress prices? Look, people have been saying that for years. Here's the thing. It doesn't actually matter whether there's some shadowy group pulling strings behind the scenes. The mechanics are what matter. Whether you call it forced selling, margin mechanics, or structural pressure, the outcome's the same. Positions got liquidated. Prices fell. What matters now is what happens next. Focus on what you can measure. Focus on flows, leverage, and spreads. That's where the signal lives, not in the noise. And right now, the measurable data is showing physical demand holding while paper sold off. That's not a demand problem. That's a positioning problem. There are probably 3 types of people watching this right now. First, you might be panicking because you bought near the highs and you're staring at red numbers. Maybe you got in at 115, 118, thinking this was going to 200. And now you're down 20% in a day, and you're asking yourself if you should cut losses. Let me say this clearly. Reacting emotionally after a leverage flush is how you lock in losses. Your job right now is to assess whether the thesis changed or just the positioning. Did the fundamental case for silver break? Did industrial demand disappear? Did above-ground inventories suddenly flood the market? Or did leverage traders just get margin called? If it's the latter, selling now means you're doing exactly what the forced sellers had to do. You're making a mechanical decision, not a strategic one. Second, you might be sitting in cash thinking you just dodged a bullet. You've been watching silver run and you stayed out because it felt overextended. And now you're feeling pretty smart. That's fair. You might be right. Your job now is patience. Forced selling creates opportunity, but only after stabilization. If you rush in trying to catch the exact bottom, you're just gambling. Wait for structure. Wait for signs that the mechanical selling has exhausted itself. Watch for consolidation. Watch for physical premiums to stay firm or widen, then reassess. Third, you might be long-term bullish and unfazed. Maybe you've been stacking physical for years. Maybe you understand the macro case, and this move doesn't shake your conviction at all. Good. Your job is risk management, not bravado. Don't confuse a strong thesis with immunity to volatility. If you're over-leveraged, this kind of move can still hurt you even if you're ultimately right. So here's what I want you to answer in the comments. Which of these 3 describes you? And what's your plan from here? Because understanding where you are emotionally is half the battle. For all of you, the universal principle is the same. Price collapses caused by leverage behave very differently from collapses caused by demand destruction. When demand dies, physical premiums collapse. Inventories surge. Industrial users pull back. You see it in the data everywhere. When leverage dies, paper sells off hard while physical stays tight. Premiums hold or widen. Buyers still show up. That's what we're seeing now. Learn to tell the difference. It'll save you a fortune over your lifetime. Here's where I stand. I'm not panicking and I'm not blindly buying either. I'm watching 3 things very closely. First, I'm watching whether silver can stabilize in that $95 to $100 zone. Historically, that's where forced selling exhausts itself. If it can hold there for a few sessions, build a base, show some two-sided action instead of just straight liquidation, that would tell me the mechanical pressure's fading. Second, I'm watching Shanghai premiums. If those stay above 20%, that's the heartbeat of physical demand still beating strong. The moment those premiums collapse, that's when I'd start worrying about real demand issues. Third, I'm monitoring futures open interest. That's the total number of outstanding contracts. If open interest drops significantly over the next week, that confirms leverage actually reset. Positions got closed, the system deleveraged, that's healthy. That creates room for the next move. Based on my analysis, this move was mechanical, not emotional. It was structural, not random. The fundamental picture hasn't changed. Silver's still undersupplied relative to industrial demand. The green energy transition still needs massive amounts of silver for solar panels, electric vehicles, grid infrastructure. Central banks are still buyers of gold, which typically support silver on a lag. The macro backdrop of debt, deficits, and currency concerns hasn't gone anywhere. None of that changed in 24 hours. What changed was positioning. What changed was that too many traders were leaning the same direction with too much borrowed money. And the market reminded everyone that leverage cuts both ways. If history rhymes and silver finds support here and builds a base over the coming days or weeks, the move that follows could be just as violent to the upside as this move was to the downside. I'm not predicting that. I'm just saying the pattern's been consistent. Sharp leverage flushes don't mark the end of bull markets. They mark resets. They shake out weak hands. They clear the board. And then the trend resumes, usually stronger than before because everyone who was going to panic already did. I'm not a financial advisor. This is not financial advice. Do your own research. But if you made it this far, you're thinking critically about markets instead of just reacting. That mentality will serve you well. The people who win in markets aren't the ones who never experience drawdowns. They're the ones who understand what's happening during those drawdowns and respond strategically instead of emotionally. If you found value in this breakdown, share it with someone who needs to see it. Subscribe if you want more real-time market analysis that cuts through the noise. And stay ahead of the headlines because by the time everyone else figures out what happened, the opportunity's already gone. Think critically, verify your data, make your own decisions, stay sharp out there.